Hello again, Biopharma investors. This is Manny Vacchiano with AMP, and today I'm going to talk about near-term dilution and follow-on offerings. This is another AMP educational quickie. So near-term dilution and follow-on offerings are one of the three risks that I talked about in a prior recording that you can find on our AMP website. The three key risks, company-specific risks, in biopharma investing are regulatory approval, commercial success, and today's topic, near-term dilution. Not a pretty word for biopharma investors, or not a pretty phrase, I should say. Let's talk more about it. Small and mid-cap biopharma companies typically burn a lot of money. They've got drug candidates in clinical trials. This is very expensive, so they're typically burning millions of dollars, in many cases more than tens of millions of dollars a quarter. Therefore, they need to raise cash or they're going to go bankrupt. And they do that in follow-on offerings. Basically, they offer more shares of their stock in the public markets, and that brings them cash. This also dilutes existing shareholders, which should lower the share price. If you offer 10% more shares that were not previously available to the public, in a very basic sense, it should dilute your price 10% for current shareholders. We'll see, and you'll see if you're an investor, you'll know this, that these dilution events, they typically follow positive clinical report outs. We'll talk more about that in a minute. Now, these companies can also help to fund themselves through loans, but those usually happen much further along in the process. Of course, there's no dilution in a loan, which is nice for investors, but it's hard to get lenders to loan large amounts of cash until these drug candidates are very late, close to approval or approved in early commercial. So typically, we're dealing with dilution events. Now, when is a dilution event likely? One important point is, from our experience, these companies target around 2 years of cash. That's what they like to have on hand, even though usually they're running below that amount, but that's what they'd like to have. And follow-ons occur when the stock price is high. If you want to raise money for your company, the best situation for you is the stock price is high. I offer 1 million shares. Stock price is $100. That's a lot better than when the stock price is $10 or $1. So when the stock price is elevated, that's when these companies are much more likely to raise cash. And that happens first after a positive catalyst event. And literally, you see this all the time. If there's a positive catalyst event, doubles the stock price, within a day or a few days, these companies will announce a follow-on offering. The second time this happens is when the overall biopharma macro is elevated. So share price is elevated because we're getting a nice tailwind from the biopharma macro, so let's raise some money while we've got a nice hefty share price. So that's when the dilution event is likely. And there's another factor of this, which is share price is high and we need cash. If we have less than 2 years of cash and share price is high, especially if we have like less than 1 year of cash, then we're really starting to get itchy to raise more money. So where do we find this information about cash on hand and burn rates? Well, that's it's publicly available. It's in the SEC filings, the quarterly filings, and also filings that occur when there's a follow-on offering. And these you can also find in press releases. It's good to subscribe to the email list in the investor relations section of any of the companies that you're interested in. And then you'll be notified when these quarterly calls happen, and there's a nice email typically that summarizes burn rates and cash on hand and that sort of thing. We also have some of this information available on our company pages on the AMP website, and we keep adding more and more information there. So check the company pages on AMP, and we probably have information at least from the last quarterly report out. But you've got to be careful, as you'll see in some of the examples I'll show you. You really have to check to make sure you're looking at any recent follow-on activity, recent events. The other thing to keep in mind is the burn rate. The burn rate's basically the negative net income of these companies. but the burn rate can change over time. So if a company, for example, is close to commercializing a drug, well, their burn rate is going to start going up probably as they increase their SG&A expense. And so what their burn rate was for the last 3 or 4 quarters may be much lower than what the burn rate is going to be in quarters ahead. So you kind of have to have an idea of the situation of the company as you're looking at burn rates. Let's look at our first example. Cara, a company that I personally and as at AMP, we like Cara. They had a follow-on offering in July of 2019. Here's the press release that came out about the offering. And this was announced after close, after hours on July 24th, and they announced the close of the offering after hours on July 29th. They raised $145.5 million. That was $136 million after the fees. And basically, they had about 40 million shares outstanding when they did the raise, and they raised around 6 million shares at $23 a share. So that was the follow-on event that Cara did in July of 2019. Now let's look at the Cara stock price and what happened here. So basically, on 7/24 at close, before they announced their follow-on, they were $26.27 a share. On July 30th, the day after they announced the close, their stock price was down to $23.75 a share. And as I mentioned, the follow-on was $23 a share. So you can see the dilution that happened about, it's not a bad event for them. I think they diluted around maybe 15%, 15%, and their stock price was down around 10%, 10, 12. So it was fine. If you look at the stock price, you'll see in this chart that this occurred near their peak in earlier July, and then the stock event came, this follow-on was announced, and that's what dropped the stock price down. And then it plateaued for a while until like mid to late September when there was a biopharma macro drop, so that kind of brought it down. The bottom line is they raised when their stock price was high. The stock price held at a plateau after that, so I think this was a pretty good raise for them. Not a tremendous strength, but overall was fine. If I was Derek Chalmers, the CEO of Cara, hey, I picked a good time at our peak, and I didn't create real downward pressure because of the raise. So pretty good raise, pretty typical. Now let's look at Cara currently. Basically, at the last quarterly call, they had $193 million in cash. They were burning about $33 million a quarter. Now it's also, you got to look also at the long-term investments. So they also had $56 million of marketable securities. The above screenshot is from our company page. We're going to start at probably adding in marketable securities as well, so you have that. So they had about 2 years of cash and securities on hand as of the end of Q3 after they did that offering in July. Now they've got several major catalyst events coming this year, and there's a good chance, and since they'll be significantly under 2 years of cash by the time they report these out, there's a good chance that if there's a positive report out, and there's a whole bunch of report outs happening. So if in the sum their stock price is up or even holds maybe steady, they'll likely do another raise. If we look at TG Therapeutics, TGTX is another example. We'll see at the end of Q3, they had about $72.5 million in cash. They were burning about $62 million a year. That looks like, whoa, a little over a quarter, kind of start to see a red flag. But so the dilution risk looks high if you just look at that. However, they had $24 million in marketable securities that we don't show on this page, and they did a $50 million raise in December of 19. So they reported at the end of 19 that they would have $140 million of cash, and so that's, it's not as urgent as it first appears, but still not close to 2 years of cash. So very high risk of dilution in 2020 for TGTX. Let's look a little bit more closely at their December follow-on. So this was the press release for their $50 million follow-on. They had one investor that invested in this follow-on. And if we look at their stock price, well, let's first say they had 90 million shares before the offering of 5.4 million. And so they diluted, let's say, around 6%. And the offering was priced at $9.20. So when they closed before the offering, they were at $10.11. So it looks like, okay, they diluted down where you'd expect on their price. But the day after close, they closed at $11. They actually were up. And if you look at their chart, you'll see that they've been just steadily rising ahead of a very big report out happening this quarter. So if I'm the CEO, Mike Weiss, I guess I could take it two ways. I'm happy. I mean, we've doubled in price, so I'm thrilled about that. I would have liked to have waited a little longer till I did the follow-on, because I could have gotten, that same 50 million for a lot less shares. But like I said, this is a strong follow-on. The stock did not decrease in price even with that dilution, and the stock has continued to go up into this catalyst event. So that investor is looking really good right now, but it's really going to be the question is going to be what happens with this report out. So this is TGTX, and it's a raise with a strong kind of raise here. There was no decrease in stock price from the raise, and in fact, this stock has continued to rise. So what are the take-home messages from this quickie? Well, near-term dilution is a risk for any small mid-cap biopharma company, pretty much. And this is especially a risk if there's less than 2 years of cash on hand, and most especially if there's less than a year of cash on hand. And typically these follow-on offerings happen when the share price is high. You can get the information about cash on hand, burn rates from quarterly filings, looking at cash equivalents, marketable securities, and also looking at net income. But you got to dig deeper than the last quarterly filing if you really want to get a great sense at any given point of what the likelihood of a raise is. And a strong follow-on is a good indication of strength in a stock to institutional investors. So that's what I wanted to say today about near-term dilution. It's a scary phrase, a scary situation, but it's just part of investing in these companies. And the bottom line is we're hoping we're investing in companies who have lots of good assets, good clinical trial results, and they can survive, and we can still make lots of money despite these near-term dilution events. Okay, that's all for this one. Happy investing.